The stock market is a lot like the seasons. It has cycles, patterns, and rhythms that repeat over time. While every year has its own surprises, history has shown us that certain sectors tend to perform better, or worse, at specific points in the calendar. Today, we're going to break down a powerful seasonal investing strategy for the US market that's rooted in decades of historical data and real-world performance. We'll look at 4 sectors that tend to stumble from late summer through early winter, sectors that may be better to hold lightly or avoid adding to until conditions improve. Then, we'll shift gears and focus on 2 areas of the market that have a track record of strength during this period. By the end of this discussion, you'll have seasonality in the stock market isn't magic, it's math, behavior, and business cycles rolled into one. Think about retail. Department stores make more sales during the holiday shopping season. Airlines see spikes during summer vacation months. Energy companies experience demand shifts in winter heating and summer driving seasons. These patterns influence corporate earnings, investor expectations, and stock performance. When you stack decades of market data side by side, these seasonal patterns become impossible to ignore. In the US, the Stock Traders Almanac, going back to the 1960s, has documented countless trends, like the sell in May and go away phenomenon or the Santa Claus rally in late December. Seasonality won't make you a fortune on its own, but when combined with solid technical and fundamental analysis, it can keep you from swimming against the current. Gold is often seen as a hedge against uncertainty, inflation, and a falling US dollar. Historically, it tends to perform well in times of crisis, but seasonally, the period from late August to early November has been relatively flat. Why? From a technical standpoint, gold may still be in a long-term uptrend, but right now, it's showing signs of short-term consolidation. When the dollar index strengthens, gold often retreats, and with recent dollar firmness, gold may pause before resuming its climb. For US investors, this is a time to hold core gold positions but avoid making aggressive new buys until we see. Long-term, gold remains attractive as a diversification tool, but patience now could pay off with better entry points. Copper is sometimes called Dr. Copper because it's seen as a barometer for the global economy. It has widespread industrial uses, from wiring in homes to electric vehicle motors. Seasonally, however, copper prices often dip from July through November. This is partly due to fundamentally, the long-term case for copper is strong, thanks to electrification, green energy infrastructure, and AI-related manufacturing demand. But in the near term, copper has struggled to hold gains, with recent dips tied to trade headlines and Chinese economic updates. Copper is a buy-the-dip candidate, but likely later in the year, when seasonality turns positive. For now, US investors can track copper ETFs or large copper miners but wait for clearer technical strength. Oil and gas producer stocks have a tendency to move sideways from late spring into late October. The stronger seasonal period usually starts in the winter and extends into early spring. Why? Right now, energy stocks are in a multi-year sideways pattern. US producers have been more disciplined in drilling, keeping supply growth in check, but global demand fluctuations keep the sector choppy. Hold quality energy names if you already own them, but avoid adding large positions until late October or early November when the seasonal lift begins. The materials sector covers companies that produce chemicals, forestry products, building materials, and metals. Seasonally, this sector tends to see stronger performance in the winter months, as industrial demand picks up. Late summer often brings slower activity as manufacturing orders pause and commodity input prices stabilize. Recent breakouts in the sector have failed to hold, suggesting investors are not yet ready to commit heavily. Patience here could pay off. US investors might revisit materials in late fall for potential strength into Q1. The SIBO Volatility Index, VIX, tends to have its strongest months from July to November. This period often coincides with market pullbacks, earnings disappointments, or geopolitical events. When the VIX is low, it often means complacency in the market, and that's when sudden spikes can be most profitable. Right now, the VIX is hovering near 15, which is historically low. That suggests a short-term market calm that may not last. For most US investors, volatility should be used as a hedge, not a core holding. Avoid leveraged volatility products unless you're highly experienced. Consider small VIX-linked ETF positions or options strategies to protect gains during potentially choppier months. Real estate investment trusts, REITs, often see seasonal strength from July into October or November. This can be linked to interest rate trends, economic stability, and demand for yield. Some REIT indexes are bouncing off lows, targeting potential gains of 10 to 15% into late fall. For income-focused investors, REITs also deliver steady dividends. Focus on quality REITs with strong balance sheets and stable cash flows. Industrial REITs, data center REITs, and certain residential REITs look particularly attractive. The market's seasonal patterns won't always play out exactly, but they provide a statistical edge. Just like a farmer knows when to plant and when to harvest, a smart investor knows when to lean into strength and when to ease off in weakness. By respecting these historical patterns and blending them with sound analysis, you position yourself to make calmer, more calculated decisions, rather than chasing heat in sectors that are cooling off. The market is never just about finding the next big winner, it's about knowing when not to fight the tide. Right now, that means staying patient in gold, copper, energy, and materials, while keeping an eye on volatility and REITs for opportunity.